Hello, Splendours. Welcome back to Splendid Richness. Did you know that sometimes it's what you spend, not what you earn, that counts? We do know how much some people may end up spending without having some knowledge about money. Many of us spend much of our lives thinking about our finances. Wealth creates these persistent social contexts that you live in throughout your life. We put together this video for you to educate you on the top 10 things people don't understand about money. Stay with us to find out. Number 10. If you wait to save what's left at the end of your payday, you won't have anything. It's actually better to pay yourself first by transferring the money you've budgeted to your savings account as soon as it lands. When you transfer some money to your account a fortnight after getting paid, after covering all your outings, you will come to realize that you don't have much left, or it's way below what you had hoped for. Why not set aside what you need saved first? Did you know that value is very different from price? It's very tempting to buy the cheapest option available, but if you have to replace it more times than the pricier option initially, well, it wasn't a great decision purchasing the cheaper option. If we were to give an example, a car that has a cheap upfront cost and breaks down frequently is probably not what you would want to invest in. Putting debt on the mortgage can end up costing you more. With current home loan interest rates below 5%, it's obviously much cheaper than taking a personal loan. Therefore, adding things such as a new car that you have purchased on the mortgage is quite a tempting offer. However, if you look at the long run, paying off the mortgage over 20 years will eventually make you pay way more interest. For instance, if you put $5,000 on the mortgage and take 20 years to pay it at a rate of 5%, it will cost you $7,914, which is $700 more than what you'd have paid over 5 years at a personal rate of 15%. Number 7. Your house should not be an investment. As the adage goes, if you can't buy it twice, you can't afford it. It can tempt you to think of yourself as a homeowner investor. Your house is a purchase you make with emotional factors in mind. You're thinking about your family and where your kids will spend their childhood memories. If you sold your house, you'd definitely think of another house in the same market, so the capital gains that you were thinking about are wiped out. Therefore, paying a mortgage in order to retire is quite a key part of providing comfort in your old age. At number 6, not having insurance is a false economy. Yes, sure, insurance is expensive, but not having it could make matters even worse. For instance, if you don't have a car cover and have an accident that leads to a write-off, you could end up devastatingly out of pocket. However, with an insurance, you might not end up liable for repairs on someone else's car as well. It's also important to have income protection cover and other personal insurances if you have mortgage debts, so that you don't end up losing everything you earned. The next point is done by the majority, buying because everyone else is. When everyone is hopping in to buy shares or people assuring you that nothing can go wrong, this is when you know that a correction is just around the corner. These investments do well over time. However, this would mean you gritting your teeth or biting your nails and hanging in there through a downfall, which can be hard to do more so if you bought just because everyone else did. Safer is sometimes not always better as you think. Some tend to take risks. Remember that investing is always an uncertain business. Higher expected returns mean more risk to your money and vice versa. This may not always be the case, however. Once you have made your portfolio efficient, the only way to increase returns is to increase risk. Number 3. Diversify. Some people think that buying investment properties in a range of suburbs in a variety of companies is diversification. This isn't the case. If you're managing a portfolio, you need to have your investments in a range of asset classes so that if it takes one hit, the other shouldn't be affected. This diminishes some of the risk. The best way to save is to focus on lowering your expenses rather than raising your income. Hannah McQueen, a financial advisor, says that a lot of people think that to get ahead you need to earn more money, but so many of her clients earn good money, but that doesn't directly translate to progress, which is the exact opposite. Your psychology of spending is the most important thing to understand. If you're a spendthrift, if you lack a financial strategy, if you're super busy, or if you earn good money but fail to make progress, then achieving financial success is not going to be a natural result for you. You will need to develop a plan and drive a result. If you're in control of your finances, your general well-being improves as well. And for our final point, your biggest asset is your income. It's really the ability to earn income. The best thing about being able to earn something is that you are in control. You can either upskill to earn more or take extra work. Find many various ways to maximize and protect your biggest asset, and you will definitely be on the path of greater and more massive success than you can imagine. Think big, as they say. Now that we have come to the end of the tips that we prepared for you, Splendours, we hope that we have helped you even in the slightest way with this information. Go out of your way and come up with a plan that will make a great deal of change in your life. Taking the first step is always the hardest, but keep pushing, and when the effort starts paying off, even in the slightest way, let that be your motivation, Splendor. Now, let us know in the comment section which of the tips above you think would help you a great deal. Thank you for watching, Splendor. Make sure you like, comment, and share. Kindly subscribe so that you don't miss any video that we post. Don't miss out on the great content we have planned for you. Goodbye.